The Australian Financial Review.
Hello, I'm James Thomson, Chanticleer columnist to the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. And with me today, as always, is the senior Chanticleer columnist at the AFR, the great Tony Boyd. Tony, how you going?
I'm very well, thanks, James. Geez, you're really going over the top this week.
Well, I'm very excited about this week's episode. This week, we're going to look at what the debate over the purpose of superannuation means for your savings, reveal the big three consumer trends from earnings season, and look at where house prices go next. But first, Tony, you spent Wednesday at the Financial Review's Workplace Summit, and looking on from afar, it seemed there were a couple of big things the audience wanted to focus on. One was migration, and the other one was remote work. Can we look at migration first? Was this sort of sold as the silver bullet for worker shortages? Do you feel migration's going to pick up quickly?
Look, I think the speech from the Minister for Home Affairs, Claire O'Neill, was pretty emphatic that they see a big problem in the way the migration system's working and they need to fix it as quickly as possible. The problem is that these complexities and I suppose the spaghetti of like just hundreds, it seems, of different types of visa programs are not going to be fixed easily, which didn't sit well with some of the businesses there. I think Wesfarmers, the Commonwealth Bank and others were really saying, look, we're losing the war for talent. Countries like Canada, Singapore are just doing so much better. They can process their visas 3 to 4 times faster. So, but I think the Minister also identified this incredibly difficult issue of how the temporary visa program is just suddenly, without anybody really noticing, got to 1.9 million people, and it's overwhelmed the permanent program, which is meant to bring in the skilled workers. And so that there's a lot of work to be done to fix this. Yeah.
It's fascinating to me, Tony, that the migration spaghetti, as you quite rightly called it, when we weren't issuing any visas, when the borders were closed, that might have been a pretty good time to fix all that, mightn't it? But the opportunity has passed.
Yes, there were so many other distractions, and I think the Minister said that there was, the moment we shut the borders, about 300,000 people just immediately left who were filling jobs in the economy. It was a big blow to small business mainly.
Yeah. Now, the topic of remote work, it always it has lots of interest at the AFR. You can see the website goes off when these stories about how much time people need to spend in the office are examined. What was your mood on this? Is there any sense that the slowing economy might be sort of leading more people to come back to the office?
I think there's two things at force here or working here, James. One is that companies are actually getting far more proactive. They're actually saying you must be in the office for a minimum certain number of days. For a lot of companies, it's 2 days. Yep. And the companies that do that say that their workforce is far more engaged. I think Generation Z, which is, the young people of today, are very interested in hybrid work. I ran into the CEO of a big financial institution in the city this week, and he said that he'd had 18 graduates came to do interviews in this, beautiful modern building in Sydney, and probably the best working surrounds you could have in 2023, and all they wanted to talk about was hybrid work. So the other big comment on that was from the Public Service Commissioner, Peter Woolcott, who was on a panel that I was moderating, and he's basically looking after the learning development of 250,000 federal public servants. And he said that the federal public service is losing the race against business, which is far more willing to offer remote and flexible working conditions, but they're also getting in ahead of the public service in terms of grabbing the best graduates in the first and second year at uni. And so they've got a big task ahead of them to make sure they're getting ahead in the war for talent.
Yeah, okay. Well, another bit of big job news this week was the appointment of the first woman to run supermarket giant Coles in its 100-year history, with Leah Weckett taking over from Stephen Kane, who's been CEO for just on 5 years. Tony, I made the argument in a column this week that she sort of instantly becomes one of the most powerful female CEOs in the country, simply by dint of the fact that Coles has a workforce of 130,000 people. And also, as we've seen during the pandemic, the supermarkets are just so ingrained into public life. What do you reckon? Will she sort of rival Vicky Brady at Telstra and Shamara Wickrunner-Micah at Macquarie?
I think you're right. One thing about these huge employers is that when businesses get involved in environmental, social and governance, such as maybe the voice to Parliament, which could be compared with the same-sex marriage debate, if a CEO like her takes a position on that and the company sees it as part of their mission, their values, that they will support something like that, it could be quite influential in a referendum. So, I agree with you. CEOs of companies with huge workforces are actually potentially very powerful.
Yeah. The ASX 200 still only has 12 female CEOs, which just isn't enough. We lost one in Sue Lloyd-Hurwitz from Mirvac, who retired, and so Leah comes in and takes her place. But we'd love to see lots more. I thought the way that her career has developed was really interesting, Tony. Very deliberate strategy. She's had sort of sponsors throughout her career, so CEOs and people on the board have helped shape her career. And she's taken this quite portfolio approach to the way she's developed at Coles. She's been the CFO, so Chief Financial Officer, the head of HR. She's run the Victorian supermarkets. She's now the Chief Operating Officer. It's a great breadth of experience to take the top job. Operational, hard and soft. It's pretty clever.
It is, and I think we know that the best CEO transitions are to someone who works inside the company. Yeah. In fact, I spoke to Alan Joyce at Qantas this week, and he says that, from the moment he took over, he wanted to make sure that there was someone at Qantas in-house, or at least a selection of people with the talent to take over, so the board would be able to get an internal candidate. By the way, he was asked how long he's staying, and he said his position hasn't changed. He will be there till at least the end of the year.
Right. One other thing about Leah, she is a consultant, Tony. She used to work at McKinsey. Coincidentally, Stephen Kane's a former consultant, and Brad Banducci at Woolworths is a former consultant. Are we sensing a bit of a pattern here, Tony?
Well, I think if you look around the successful CEOs of the ASX, you'll find them have been alumni of Boston Consulting Group, Bain Capital, Jane Herdlicker at Virgin, Ahmed Fahour, who was at Latitude, retiring from Latitude and previously at Australia Post. I mean, what we usually find is that they surround themselves with, people they know and trust, and they tend to be also have worked at the same consulting firm. I suppose the challenge for the boards is to ensure that when they do tenders for consulting work, they're not just going back to their old firm just out of some sort of loyalty. It is actually the best and brightest who are working for you, not just your old workplace.
Yeah. Fascinating, though, that the consultants have made such a market supermarket businesses. I don't know why that is or what it is about grocers, but it's definitely a trend. Three's a trend.
Yeah, look, my only thought on that is it's probably the data-based analysis. As we know, every consultant turns up with the best analysis of the available data, and that drives their decisions. The amount of data that these organisations is collecting is phenomenal, and they're obviously using it very strategically whilst protecting our privacy.
Indeed, Tony. Well said. Well, Tony, let's jump into our first topic. While earnings season, of course, ramped up again this week, the other big story at the AFR has concerned the latest attempt to define the purpose of the super, which the Labor government says it wants to define in this way, and I quote, The objective of super is to preserve savings to deliver income for a dignified retirement alongside government support in an equitable and sustainable way. A few words in that statement have been, well, perhaps I'd say triggering, Tony, particularly the words equitable and sustainable, and that's widely been taken as code for changing the tax treatment of super. Tony, the most obvious way to do that would be to put a cap on super, which would mean the favourable tax treatment you get through your super fund is limited to a certain amount. And numbers like 2 million and 5 million have been tossed about, but we seem to be settling on $3 million. Is a cap sensible, and what's the right level, do you think?
Yeah, I think it is, James. I mean, after all, this system was set up to fund retirement. It's not meant to be a tax-effective sinkhole for the wealthy. And when you consider there's 11,000 funds with more than 5 million in them, including one fund with 400 million in it, that really is way outside the scope of just saving for retirement. And as far as super funds and their purpose, they're there and they're generous tax concessions. Once you've retired, you can get your income tax-free. I think it's reasonable to think that a person living now could fund themselves to their age 90 with a super cap of about $3 million. You know, making some assumptions about capital growth. And I saw a great chart from Credit Suisse last night that the Australian stock market was the second best performing stock market in the world since 1900.
Wow.
With an average return of 6.4%. Per annum over that period. So when you think about putting some assumptions, I'm sure the assumptions are much lower now, and I think Credit Suisse said that probably you'd expect the equity market of the future to return about 4% per annum. But when you plug those assumptions into a super fund balance of about 3 million, even someone who draws down about 100,000 a year would get to age 80 and probably have 5 million in there. So I think that's enough money. And then the question is just how they've gone about it. Do you think it's been flying too many kites and creating too much confusion, or?
Well, I mean, it's such a sensitive area. I mean, I guess the question is, super's a long-term investment. You know, for most people, it's 40, 50, 60 years, depending on when you plan to retire. So there is a reasonable question. Given you invest over that time frame, should you expect that the rules aren't changed on you? And I think that's what we've seen, that the so-called teals in Parliament have hit back at this super cap and said, hang on, you know, the voters we represent, who are generally in wealthy suburbs around the country, particularly on the eastern seaboard, they invested based on a certain set of rules. You can't pull the rug out from under them. I've got some sympathy for that view, but it is a tough one. Should the rules change with the times, or should it be sort of set and forget? I mean, I think, you know, these things evolve, and I think you've got to be able to have some flexibility, don't you, Tony?
Yeah, I think so. I thought it was interesting that the ACTU former Assistant Secretary Gary Weaven, who was one of the influential power brokers of super in its early years, came out and said that he thought constant changes were undermining people's confidence. He said Jim Chalmers made a political mistake by letting it swing in the breeze. And also, I didn't think Stephen Jones was that helpful when he came out and said some analogy like super is like a hive of bees producing honey and we need more honey and there's lots of honey to go around. I mean, when everyone's saying they're trying to stick their hands in the honey pot as a sort of more tax measure, I think he's a little bit off the mark there.
It didn't work for Winnie the Pooh, and it's not going to work for Labor, perhaps. One extension of the honeypot analogy is Jim Chalmers is very keen on this idea of getting super funds to help with nation building. Now, you sort of get the idea here that, and Chalmers' logic is that super funds need a growing and stable economy to deliver returns to their members. And so if there's a big project that helps deliver a growing and stable economy, say affordable housing or energy transition, then why shouldn't they get involved with that? I've got a bit of a problem with this, Tony. For starters, the purpose of a super fund is to generate financial returns for their members, all of whom have very different motives and needs and obligations. So that's the starting point. If these nation building projects can generate good returns, go for it. Happy days. But I also have a bit of problem with, the government of the day picking its pet projects and saying, hey, super funds, be patriotic, do the right thing by the country and get involved in this. Is that what super's for, Tony?
Well, look, whatever happens, we know that the trustees must perform their duties and exercise their powers in the best financial interests of beneficiaries. I mean, the Chook Super Fund, the two trustees, myself and my wife, we've got this obligation too, and every year I have to sign off on a document about that my selection of investments were done in the best interest of the members. But we know the concept gets stretched. For example, I've never understood why Industry Super Australia have poured $30 million into the new daily. Now, Industry Super, of course, is owned by 24 industry super funds. I just don't see the logic in putting that amount of money over a period of 12 years or longer to make zero. All of the investments I think trustees have to approve have got to be in the interest of the members. And you wouldn't get into social housing unless you knew that you could make a decent return from it, and that's probably a return above inflation or at least above the cost of capital. Now, of course, we know the only way that works is through subsidies for underwriting the bonds or underwriting the rent that's collected. So it's a difficult balancing act that the Treasurer will have to navigate, and I think the May budget is going to be a pretty interesting turning point in this whole debate, because that's when the rubber hits the road.
Yeah, that's exactly right. My feedback from inside the super funds was, they'll politely agree that nation building is a great thing, but their focus is on members and financial returns, and all the benchmarks, the benchmarks that are published monthly and quarterly and annually. Everyone's looking at those, so they cannot afford to let their financial performance slip. And as a final kicker, everyone inside a super fund is remunerated on those good financial performances. So they've got a personal stake in continuing that rather than getting distracted by some government project or another. Tony, a last one, and we're not asking you to tell us how big the Chook Super Fund is, but you're about to hit the golf course for an extended period as you move into the drawdown phase. What do you reckon the number is now that you need to retire comfortably?
Well, the current cap is 1.6 million for each individual, and so as I said earlier, you add it together, it's about $3 million, and that is enough. What happens, when you get to my stage of life, you've, like most baby boomers, you've got to focus on the income, and it's actually quite a good time to do that. This, as I read somewhere, this is the year of yield.
Yes,
and so I'm trying to do that, and this week I put some money into a couple of credit funds yielding about 8%, and they're of course tied to the bank bill swap rate, which probably is going to go up. And I also put some money into a self-storage property, I think yielding 7%. I mean, the change that happens as you get older in your super is something that some, like Vanguard's new product, which has a very low fee, puts you into sort of what they call the life cycle fund. And that will automatically change your asset allocation as you get older. But of course, young people, it's not so important. You just buy stuff that will yield capital gain and grow.
Yes.
And
yes.
So yeah, there's obviously horses for courses. And by the way, I'm not hitting the golf course. I'll be hitting the surf.
Yes, lovely. Good to hear. Good to hear. All right, Tony. Well, as we said, it was a huge week for reporting season. I think the Chooks beat last week's record of 13 CEOs and talked to 17 CEOs this week. And I've got to say, we learned some fascinating things about how the consumer is shifting as the economy slows. The first place I'd like to start, Tony, is at Domino's Pizza. Now, it had a shocker this week. It saw its shares fall almost 23% in a day after reporting weaker than expected sales. Tony, I would have thought that cheap pizza would just be about the perfect food for a economy under cost of living pressure, but Domino's introduction of a delivery fee, and they raised their prices a bit, that's turned the pizza buyers off, and sales have been weaker since December. The company's now going to use flexible vouchers to try and get sales back up, but what does this say? That the cheap and cheerful pizza isn't faring as well?
Yeah, there's obviously cost consciousness creeping into everybody's budgets at home, and that is a really interesting outcome because, as we know from what you said last week, people are buying the top quality wine above $30.
Indeed.
And yet they're not willing to pay for the pizza to be delivered. Personally, look, I've never used Domino's. I'm sure it's really good, but I go to the local guy up the road and actually drive up and pick it up so I can have a bit of a quick chat to him.
Right.
But, that's a really interesting one. I mean, Woolies was another case, wasn't it? An example of where the sales and profit numbers showed a distinctive shift in consumer behaviour.
Yeah, exactly.
Is that right?
Previously, Brad Banducci, the CEO of Woolworths, has talked about trading down, and that sort of makes sense, you know. People go from fresh food and they choose frozen alternatives or even canned alternatives. They go from the best cuts of beef to lesser cuts of beef, and then they go to chicken, which is cheaper at the moment. So trading down, that makes sense. But he's seeing this trend, which is called trading in, and that's where people are going off eating out at restaurants, which has got markedly more expensive in recent times, and instead they're focusing on eating in and entertaining more at home. So they're buying more stuff for the pantry, and then they're treating themselves to what Woolies likes to call affordable indulgences. Apparently, nice cheeses are doing okay, and the promotion on ice creams has been going off. So Tony, I'm not sure how your ice cream intake is going, but what do you reckon? It has got a lot more expensive to eat out, and you can sort of see how this trend makes sense.
Well, I'll never forget the chairman of Collins Foods, which of course owns KFC, making the argument to me that they were the best option for a family in the western suburbs of Sydney or anywhere in Sydney or anywhere in Australia, because for $24 you could feed a family of 4.
Right.
So, takeaway food is often not the most healthiest option, and you might find you could get just as good a feed by going to Coles and buying some fruit and veggies. But I suppose people are time poor, and these are the reasons why companies that are in that Domino's space normally actually do quite well.
Yeah. The one interesting thing Banducci did say was that he felt inflation has peaked and is starting to roll over in some areas. He said 6 months ago the price of everything was going up, and now there's pockets of value. So that's probably a bit of good news for Reserve Bank Governor Phil Lowe. One other consumer trend, Tony, that I wanted to talk to you about. You mentioned before you talked to Alan Joyce this week. There is a man having absolutely no problems with demand. He can't sell enough plane tickets at the moment.
Oh, look, this is just, they are immune to the cost of living crisis. Record earnings in Qantas domestic, Qantas international, frequent flyers. And it was quite useful. They put up a chart of their regular travel intention survey. They do it every month, and it's done for internal purposes, but they decided to release it this week. And, of course, it shows that compared to 2019, twice as many people expect to travel domestically, and 60% more say they'll travel internationally.
Yikes.
And then they asked the question, how do you intend to change your spending in each of the following areas in the next 6 months? Well, the net spending was more positive by 33% for international, 31% for domestic travel, and the net spend was negative 16% for clothing and accessories and negative 20% for beauty products. So think that Australian travellers used to spend $45 billion a year pre-COVID overseas. This is obviously coming back like a steam train, or should I say a 787. So, yes, it's. I suppose it does raise the question, James, and you might have a better point of view on this than me, but is it wrong for companies to earn so much money without putting more capacity on that could actually lower prices?
Yeah, this is the trade-off going on all across, and I don't think there's a clear answer, but this is the trade-off that all businesses are thinking of. How do they get volume and margin right at the moment? How do you ensure you can keep growing, but keep growing profitably while costs are rising? And then, yes, as you say, you don't want to over-earn. We've seen companies boost their profit margins so far that people just get sick of that and look for alternatives, and that might mean in Qantas's case they cut back from travel or seek other airlines. So there is that you can over-earn, you can earn too much, and I don't know if Qantas is quite getting there, but it sort of feels like it, doesn't it?
Yeah, I mean, you get some really strange contradictions. For example, Vicky Brady at Telstra was critical of NBN for lifting, the wholesale price of the 50 megabit plan. At the same time, when releasing her results, she said that the rental that they charge NBN for the use of its ducts would go up by inflation of 7%. So they're contributing to the increased wholesale prices and cost of NBN, which is trying to get it back through the retail service providers, which are then criticising them for putting up their prices.
Yeah.
So there's all sorts of intricacies in the vertically integrated supply chain.
You raise a great point. Let's finish on this one, Tony. Will companies be able to continue to push through these big price rises and point to inflation, or is that gonna end and we'll see a margin squeeze?
I think there's probably going to be a margin squeeze. I think the political pressure that's coming, particularly on the banks or any sector of the economy where there's a duopoly that could potentially be over-earning, are going to have to feel that, especially at a time when ESG is such an important issue and we're all supposed to embrace values-based capitalism.
Yeah, indeed. Well, Tony, we're going to come back after the break and look forward to the next edition of our House Price Index coming out next week.
Hi, I'm Lisa Murray, host of The Fin, a podcast from the Australian Financial Review that takes you behind the deal, inside the boardroom and along the corridors of power. Every week, we focus on one important story, so join us every Thursday to hear our take on the money, power and personalities behind the news. Follow The Fin wherever you get your podcasts.
Okay, Tony, welcome back. We've got another few days of reporting season to open up next week. I think there's a couple of interesting companies reporting. Harvey Norman, so we'll get another look at the consumer. Woodside should do very well out of higher energy prices. And one of your old favourites, TPG. What are you looking for there?
Well, it's funny. I was going to the city yesterday and ran into Iñaki Barroeta from TPG, the CEO there. He was off to a dinner and he obviously gave nothing away about what the company's results will be. But that is an interesting sector because Telstra has been putting up mobile prices. Others have said that rational pricing has returned to that sector, so they should probably do quite well. Their biggest issue is their regulatory overhang of the ACCC knocking back their network sharing agreement with Telstra, and that'll probably drag on well past June 30. So, the telco sector has enormous interest, and there's a lot of people saying it's a place to invest because of the pricing power everybody following Telstra up the price chain.
Good point. There's a big bit of data out in America on Friday night, US core PCE, which is personal consumption expenditure. It's sort of another one of these guides to inflation, but it's the one that the Federal Reserve, the central bank in the US, looks at really closely. So watch out for that. If you're listening to us on Saturday morning, make sure you check afr.com and see where that bit of data came out and how it moved the markets. And finally, Tony, house prices at the start of every month. It's the 1st of March next Wednesday, so we'll get a new house price index from CoreLogic. I guess we'll see house prices tick down, and the falls from peak are now running at close to 10% across most of the country. My question for you, Tony, is how much further have house prices got to fall? Have you seen anything over earnings season or recently that gives you a bit of a clue either way on this one?
Yeah, look, I think the house price falls are almost done. I don't think we should underestimate the impact, the powerful impact of China's opening up. And I'll give you an anecdote, and I don't want to say that the North Shore of Sydney is a proxy for the entire property market of Australia, but one of my neighbours who I've known for 20 years, who lived up the street, sold her house.
Right.
A Chinese buyer came in, had landed at the Sydney airport that morning from mainland China. Within 5 minutes of looking at the house, made an offer.
Yikes.
The buyer then went and made an offer at another house, but didn't go ahead with that, came back and bought the house. So this is an amazing sort of situation where the desire for Australian property from foreigners is very strong. And I think as migration comes back, China, reopens. I mean, Alan Joyce said they want to put more flights on from Hong Kong to Australia, but they can't because of the restrictions in that city. So I don't know. I think it might be close towards the end of that. What do you think?
I spoke this week to Tarun Gupta from Stockland, which is one of the big developers. He's quite bullish about the medium-term outlook for property, basically because the supply-demand situation is still pretty poor, and you can see that from how tight the rental market is. But the one bit of caution he had was that rates are still moving, and while rates are moving, that weighs on buyer confidence. So perhaps we're probably likely to see 2 or maybe 3 more rate rises. So until that we've hit that peak and things settle and people have got a bit more certainty, I think we're still going to see pressure on house prices. I think we could still see another 5 or even 10% depending on how things go over the course of the year. So one to watch. Wednesday's our next lot of house price data. Tony, we love our questions from our audience and we're getting some crackers. You can send it in to chanticleer@afr.com. And this week's question comes from Joanna Nugent. She says, I'd really appreciate it if you could help me predict the Big Four's bank profitability when the rest of the mortgage holders have to switch from fixed rate to variable mortgages. I thought that the banks would be much more profitable in terms of net interest margin when their mortgage holders have to pay close to 5% interest compared to paying below 2%. But my husband says this is not necessarily correct because we have to look at bank swap rates. Tony, help Joanna out.
Well, look, I hate to say it, but I think your husband's right, Joanna. Fixed rate loans have a profitability locked in from the start at the point they're written, which is why they're so costly to get out of. If you try and get out of a fixed rate loan, you'll have to make a cash payment back to the bank. So floating rate loans, their profitability is tied to the cost of funding, and there's a couple of factors there. The $188 billion term funding facility that the RBA gave the banks to support them during COVID has to be fully repaid in September and June next year. So they're out there getting wholesale funding at the moment.
I think Joanna's right. I mean, I'm not going to give the points to Joanna's husband completely. I think Joanna's right in theory that their profitability should improve as this switch happens. Fixed rate mortgages are generally lower margin, and you would think that as rates continue to rise, that the bank's margins would go up. But the problem, Joanna, in addition to that funding issue that Tony's just taken you through, is the banks are killing each other to win mortgages at the moment. They are undercutting each other like nobody's business. And so we're seeing these mortgages come under pressure, and all the bankers seem to be saying, sorry, but the margins that we're seeing, the margins that you expect us to enjoy just aren't going to be there. So I reckon it's going to be a tough year for Big Four bank profitability for the rest of the year. We might have actually passed the peak in terms of their net interest margins. So let's see. Well, Tony, a quick recommendation from me before we go. I spoke to Microsoft's corporate VC corporate vice president of security the other day, Vasu Jakal, and she was fascinating to speak to. But I've also just finished a book by someone called Nicole Perlroth, and it's a book called "This Is How They Tell Me the World Ends," all about cybersecurity and how nation states and hackers and all sorts of nefarious villains are trying to hack our everything, from our iPhone to our computer to our Fitbits and everything in between. It's a book that makes you never want to plug into a computer again, but here we are doing the podcast, and we'll continue to do that. Cybersecurity threats be damned. Anything from you, Tony?
Yeah, look, I've read that book. I thought it was excellent. I'm reading the new book on Macquarie Group called The Millionaire's Factory by Joyce Malarkis and Chris Wright, both of whom have written for the Financial Review. I'm constrained on what I can say because I've signed a confidentiality agreement ahead of the book's release in Sydney next Tuesday. But I think I can say, without breaching that this book will sell well. But look out for my review of the book in next week's Tuesday's paper.
Bit of an air of mystery. Something to look forward to. Love it, Tony. Well, thank you very much for your attendance today.
Yes, no, thank you. It's been good.
Great fun. And we'll see you all next week. Well, if you like the podcast and you want to hear more, consider rating and reviewing us, as it helps others find us. And follow us on Spotify or Apple or wherever you get your podcasts. At The Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to The Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thomson, and Tony Boyd. The producers are Lap Fan and Alex Gow. Our theme music is by Alex Gow. See you next week.
The Australian Financial Review.